Welcome to the Byte-Size Brief. It is April 3, 2026, and today we are putting NVDA completely under the microscope. So let's get into it. Usually when we talk about a company reporting a record-breaking year on this deep dive, the narrative is, it's incredibly straightforward.
Right, the champagne is popping.
Exactly. The financial press is just throwing around superlatives, and the stock chart looks like a rocket leaving the atmosphere.
Yeah, I mean, that is the standard expectation. It's a textbook bull run where the market universally rewards just, phenomenal historical performance.
But look at NVDA right now. That simple, happy narrative is totally fractured, and I find the psychology of it absolutely fascinating. I mean, they just reported their biggest year in corporate human history, $215.9 billion in revenue.
Which is an enormous figure.
Just to say that number out loud feels absurd. Yet, if you look at their stock year to date, it's actually down about 8%. Wall Street is treating a historic triumph like it's some sort of structural warning sign.
It's a profound financial paradox, really. The fundamental underlying business metrics have literally never been stronger, but the market's reaction is, well, it's extremely cautious. We're essentially in the middle of a massive reevaluation.
Which is exactly why we're doing this deep dive today. For you, the retail investor listening right now, you are looking at the ultimate crossroads. Is the AI hardware supercycle finally peaking and running out of steam? Or is this temporary 8% dip just a generational buying opportunity hidden in plain sight?
And to answer that properly, we really have to ignore the flashy headlines. We need to dig deep into the mechanical realities.
Right, cut through the CEO hype.
Exactly. We need to unpack the hard data from their Q4 fiscal year 2026 earnings, analyze the paradigm shift they just unveiled at the GTC 2026 conference, and crucially, I think, look at the physical and competitive bottlenecks that are rewriting the rules of the AI hardware game.
Okay, so compared to last quarter, what actually moved the needle here? Before we project into the future, we have to understand the immediate financial reality. What are the hard numbers?
The numbers are, frankly, staggering. If we look at the sequential jump from Q3 to Q4 of fiscal year 2026, total revenue for Q4 hit $68.1 billion.
Wow.
Yeah. That is a 20% increase from Q3, which sat at $57 billion.
Just to pause on that for a second. A 20% quarter-over-quarter jump for a company operating at a multi-hundred-billion-dollar scale.
Yeah.
That sort of defies the law of large numbers. Where is all that cash actually coming from?
Well, the vast majority is flowing from one highly concentrated source, which is the data center segment. Data center revenue specifically hit $62.3 billion in Q4.
Okay.
That's up 22% sequentially. It now accounts for over 91% of their total revenue.
So gaming GPUs, automotive chips, professional visualization, all the stuff they used to be known for, that's basically just a rounding error now.
Mathematically, yes. But what should really grab your attention isn't just the top-line revenue, it's the profitability. NVDA maintained gross margins of approximately 75% through this massive scale-up.
Wait, 75% gross margins. Let me push back on that a bit. Because in any normal hardware business, if you were pulling 75% margins, you're basically hanging a giant neon sign in the sky that says, "Competitors, please come undercut me."
Right, usually it does.
It invites a flood of cheaper alternatives. So how are they defying basic economic gravity here?
They're defying it because currently the alternatives simply cannot handle the generalized AI workloads at that exact same scale. NVDA possesses immense unprecedented pricing power.
I see.
They are charging a premium, and hyperscalers are just paying it because the cost of not having the compute power, the risk of falling behind in the AI arms race, is far greater than the premium NVDA is charging.
Yeah, that makes sense.
And furthermore, they are guiding for $78 billion in revenue for Q1 of FY 2027.
So basically, they aren't just selling more chips. They are selling the entire AI factory, and they control the price tags. But hold on, how does that actually affect NVDA's stock price for regular investors like me? If the growth is this explosive and the margins are this fat, why the 8% drop? Why all the pessimism?
Because the stock market is a forward-looking discounting mechanism. NVDA has enjoyed a historic 3-year bull run. The current valuation has already priced in absolute perfection. Institutional investors don't really care about what you did yesterday. They care about what you will do tomorrow.
Ah, so the market expects them to beat world records every single Tuesday. And if they only tie the record, it's considered a total failure.
Precisely. The conversation on Wall Street has shifted. It is no longer, can NVDA grow? The new question keeping analysts awake at night is, can they possibly maintain a 90% market share as the AI market fundamentally pivots?
Right.
Growing at 65% year over year is mathematically plausible when your revenue is $30 billion. It requires a completely different gravitational pull to maintain that growth rate when your baseline is over $200 billion. So investors are weighing whether NVDA is finally hitting an artificial ceiling.
So how does management respond to that? Like, if the market is terrified that growth will stall out, what is NVDA doing to keep those hyperscaler customers locked into their ecosystem?
They gave us the entire blueprint at GTC 2026. We are officially witnessing the end of the Blackwell architecture era and the launch of the Vera Rubin platform.
The Vera Rubin supercycle. Yeah, I've seen the headlines, but let's break down the actual hardware for the listeners. What makes it so different?
Well, the flagship product isn't just a chip anymore. It's an integrated system called the NVL72 rack.
Okay.
You're no longer just slotting a single GPU into a server. The NVL72 contains 72 Rubin GPUs and 36 Vera CPUs, and they are all bound together by a proprietary networking technology called NVLink 6.
Let's unpack that, because throwing 72 GPUs into a big metal box isn't necessarily a new concept. Why does NVLink 6 matter so much here?
So think about how processors talk to each other. In a standard setup, if GPU number 1 needs data from GPU number 70, the data has to travel across standard network cables, which creates a massive traffic jam.
Yeah.
But NVLink 6 is a specialized interconnect that allows all 72 GPUs to share memory instantaneously. They act as if they are one giant unified superbrain. It eliminates those traffic jams entirely.
So basically, it's kind of like upgrading from a single powerful engine to an entire synchronized power plant.
That is the perfect analogy. And because of this synchronized power plant approach, CEO Jensen Huang made a staggering claim at the conference. He is officially predicting $1 trillion in cumulative AI chip revenue through 2027.
Wait, seriously?
Yes, that is double his previous estimate from just 12 months ago.
$1 trillion in demand. That is literally the GDP of a medium-sized country. I had to play devil's advocate here. Where is that extra $500 billion in demand supposedly coming from?
It all comes down to a structural shift in how AI operates, which Huang calls the inference inflection point.
The inference inflection point.
Right. For the last few years, the entire industry was throwing money at training AI models, feeding massive data sets into neural networks so they learn patterns. But those foundational models are largely built now.
Yeah, we have the models.
Exactly. So the industry is moving to the next phase, which is inference. Inference is the actual generation of tokens when millions of everyday users ask an AI to write code, generate a video, or run an automated workflow.
Okay, so training is sending the AI to college for 4 years, and inference is the AI actually going to work at a desk every single day.
Exactly. And going to work requires a constant, never-ending stream of ultra-fast computing power. And this is where NVDA made their most aggressive move at GTC.
What do they do?
To capture this specific ultra-high-speed inference market, they executed a $20 billion licensing and integration deal with an AI startup called Grok.
Grok with a Q, right?
Yes, integrating the Grok 3 LPU or language processing unit into their platform.
Wait, an LPU, not a GPU. How does a language processing unit differ from the graphics processing units that NVDA has built their entire empire on?
It's all about how the math is processed. GPUs are parallel processors. They consist of thousands of tiny cores doing complex math simultaneously, which is perfect for training models.
Right.
But an LPU uses a deterministic architecture. Instead of processing things simultaneously, it passes data sequentially through the chip in a highly predictable, streamlined path without constantly pausing to check external memory banks.
So it removes all the decision-making friction. It just acts like a high-speed assembly line dedicated purely to spitting out text and tokens.
Exactly right. By integrating Grok's deterministic architecture with the massive memory bandwidth of the Vera Rubin platform, NVDA claims they can reduce the cost of generating a token to 1/10 of previous architectures.
1/10 the cost. Wow, that is a massive economic carrot to dangle in front of their customers.
Yeah.
But here is the quiet part that nobody at NVDA seems to want to say out loud. Inference is rapidly becoming 2/3 of all AI compute. And the hyperscalers, Google, Amazon, Microsoft, are fully aware of how expensive inference is at scale. So they aren't just waiting around for NVDA to lower prices. They are actively trying to cut NVDA out of the loop entirely by building their own custom chips.
The custom silicon threat is undoubtedly the most significant fundamental risk to NVDA's future. When you look at the competitive benchmark data, custom ASICs application-specific integrated circuits designed specifically by hyperscalers are projected to grow at a 44.6% compound annual growth rate.
44%? That is terrifying if you were an NVDA shareholder.
It is, especially when you compare it to the projected 16.1% growth rate for general-purpose GPUs. I mean, every major player has an in-house alternative now. Google is deploying the TPU V7, Amazon is scaling up Trainium 3, and Microsoft has the Maya 200.
Right, and they have unlimited budgets to do this.
Exactly. These companies possess the capital to design chips that run their specific proprietary models far more efficiently than an off-the-shelf NVDA GPU. And traditional rivals are catching up too. AMD is showing tremendous data center growth and recently secured a 10% stake partnership with OpenAI.
Right, but what does all that actually mean for NVIDIA investors? Like, the hyperscalers are building their own hardware, yes, but are they actually going to stop buying from NVDA? Are they going to lose their biggest buyers?
Well, to understand the moat, you have to look past the hardware entirely. NVDA's true defense is a software platform called CUDA, and they introduced CUDA 20 years ago.
And 20 years in tech might as well be the Bronze Age. It's an eternity.
It is. Because of that head start, there are 4 million developers globally who build natively on CUDA. There are hundreds of thousands of specialized code libraries optimized exclusively for NVDA silicon.
I see where this is going.
Right. If Amazon or Google wants a developer to switch to their custom ASIC, that developer can't just copy and paste their code. They have to rewrite vast portions of it from scratch to accommodate the new architecture.
It's the ultimate ecosystem lock-in. It sounds like trying to force an entire global enterprise to switch from Microsoft Windows to a brand new experimental operating system overnight. Sure, the new OS might be slightly faster, but the retraining and coding costs make it a complete logistical nightmare.
That is the exact friction keeping NVDA's market share intact for generalized workloads. But they aren't resting on that software moat alone. The second layer of their defense is aggressive client diversification.
Diversification how?
Well, NVDA is keenly aware of the hyperscaler threat, so they are pivoting toward sovereign AI.
Meaning entire governments buying hardware directly.
Yes, nations are building localized data centers to train AI on their own cultural data without relying on American cloud providers. Furthermore, NVDA recently finalized a foundational infrastructure partnership with the U.S. Department of Energy, or the DOE.
Why the Department of Energy? That sounds a bit out of left field for an AI hardware company.
The DOE oversees the National Supercomputing Grid, advanced climate modeling, and nuclear physics research. These are incredibly complex, sensitive workloads. The key here is enterprise stickiness.
Oh, because governments move slowly.
Exactly. A tech startup might switch cloud providers every 3 years to save a few pennies. But when the federal government integrates a computing platform to simulate nuclear decay or optimize the national power grid, they do not swap it out on a whim.
Once you're in, you're in.
Right. Once NVDA embeds itself into that foundational layer of national security and energy infrastructure, it essentially becomes a permanent, localized revenue stream.
So if the demand is practically guaranteed by these sovereign deals, and the software moat is deep enough to hold off the custom silicon threat, why isn't NVDA projecting even higher growth? Like, what is physically stopping them from building more racks and making $2 trillion?
The physical world is finally catching up to the software world. We are looking at severe, unprecedented supply chain and physical bottlenecks. The first major choke point is the supply of high-bandwidth memory, specifically HBM3e.
I keep seeing that acronym everywhere, HBM3e.
Right.
What makes this memory so special that it's holding up the entire AI revolution?
Traditional memory chips are laid out flat on a motherboard next to the processor. That means data has to travel a physical distance to be calculated.
Right.
But these new Vera Rubin GPUs process data so fast they essentially starve if they have to wait for standard memory. High bandwidth memory solves this by stacking the memory chips vertically, directly on top of the processor like a microscopic skyscraper.
Whoa!
Yeah, and the data travel time is reduced to nanoseconds.
Okay, so it's a wildly complex 3D architectural feat.
Exactly. The new B200 chip requires 192 gigabytes of this specific HBM3e memory. And here is the bottleneck. SK Hynix, the primary global manufacturer capable of producing it at quality, has publicly stated they are entirely 100% sold out of production capacity through the entirety of 2026.
Sold out for the entire calendar year.
Entirely. NVDA literally cannot buy more memory right now if they wanted to. And even if they could, they face a second bottleneck with TSMC, the foundry in Taiwan that fabricates the actual silicon.
Yeah, TSMC.
Yes. TSMC is running their 3-nanometer fabrication lines at absolute maximum capacity, and demand is currently outpacing supply by 3 to 1.
And you can't just build a new factory to pump out 3-nanometer chips. I mean, we are talking about etching circuits at the atomic level. It takes half a decade to build the clean rooms and calibrate the lithography machines.
Precisely. You cannot accelerate the physics of semiconductor manufacturing. But incredibly, even if TSMC and SK Hynix magically doubled their output tomorrow, NVDA would smash headfirst into a third, much more localized wall.
Which is?
The global power grid.
Ah, the power crisis. I've read that data center operators are practically begging local municipalities for more megawatts.
It is dire. The new Vera Rubin chips draw well over 1,000 watts of electricity per single chip. When you pack 72 of them into an NVL72 rack, traditional air conditioning simply cannot dissipate the heat fast enough. The silicon will literally melt.
So you have to transition to direct-to-chip liquid cooling.
Yes, which requires retrofitting data centers with reinforced floors to handle the massive weight of the coolant, specialized industrial plumbing, and leak detection systems.
So the bottleneck of AI has shifted from designing the chip to finding commercial real estate with enough electricity and advanced plumbing to keep it from catching fire.
Exactly. It is the literal reality for several hyperscalers right now. And finally, we must objectively consider the geopolitical environment. The U.S. government has continually tightened export controls, strictly limiting the computational power of the chips. NVDA is legally allowed to sell to China.
And China was historically a massive chunk of their revenue.
It was. As a direct result of these controls, NVDA has explicitly excluded China from its Q1 FY 2027 data center revenue projections. To adapt, major Chinese cloud providers are aggressively shifting their infrastructure investments toward domestic alternatives, most notably Huawei's Ascend series of AI chips.
So if I'm understanding this right, the biggest risk to NVDA isn't necessarily a competitor in Silicon Valley building a slightly better chip today. The real risks are whether there is enough 3D memory, enough local electricity, and enough geopolitical stability to actually manufacture and plug these AI factories in.
That is an incredibly accurate summary of the macro landscape. The challenges dictating NVDA's ceiling are no longer purely technological. They are fundamentally logistical, physical, and geopolitical.
You know, all this talk about maxing out the global power grid and spending billions to retrofit data centers with liquid plumbing, it really makes me take a step back and look at the end user. Like, why are corporate clients willing to jump through all these physical hoops to buy this infrastructure in the first place? And I think that ties directly into a really provocative thought experiment we should leave our listeners with today.
I know exactly what you're referring to. It connects directly to the rather fiery, unfiltered interview Jensen Huang gave recently regarding how his own customers are deploying this technology.
Yes. The interviewer asked him about the massive wave of tech giants and Fortune 500 companies who are buying his chips, and then immediately turning around and using AI as an excuse to lay off tens of thousands of their own workers.
Right, and Huang did not hold back at all.
We really didn't. He said corporate leaders who are using AI strictly to cut headcount are out of imagination. He argued that truly innovative companies will use AI to do exponentially more with their current workforce, rather than trying to do the exact same things with fewer people.
It is a profound, almost philosophical critique of modern corporate management. He is essentially pointing out an absurdity. I am selling you the most powerful, paradigm-shifting technological engine in the history of human civilization, and your only grand idea is to use it to save a few basis points on payroll.
Exactly. And it reminds me so much of the early 1990s internet boom. When the internet first became commercially viable, legacy companies didn't invent new business models. A catalog company would literally just take their printed paper catalog and upload static images of it to a web page to save on postage.
Right, it was just a pure cost-cutting mechanism.
Exactly. It took a full decade of iteration before innovators came along and used that infrastructure to invent entirely new native economies like algorithmic ride-sharing or global streaming platforms or decentralized finance.
The historical parallel is incredibly apt there. If the primary application of this trillion-dollar infrastructure is merely automating customer service emails and generating internal HR summaries to fire middle managers, the return on investment will eventually collapse. The massive capital expenditures required to buy Vera Rubin racks cannot be justified by mere payroll efficiency.
Right. So here's the thought experiment for you listening at home. If NVDA successfully navigates the supply chain, beats the custom silicon thread, and sells the most advanced intelligence infrastructure in history, but corporate America only uses it for uninspired cost-cutting rather than inventing entirely new industries, will that projected $1 trillion demand cycle eventually hit a brick wall of corporate unoriginality?
It's a great question.
Right. Because if nobody is actually building the future, who is going to keep buying the AI factories to run it?
It is the ultimate paradox to end on. NVDA's hardware is successfully breaking the technological sound barrier, but the business models trying to run on that hardware might just be stuck in traffic.
A bullet train that just broke the land speed record, but the passengers are slowly realizing the tracks haven't even been built yet. All right, listeners, what's your take on the future of NVDA? Are you bullish, bearish, or just sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.